Good morning, everyone, and welcome to Tuesday Morning BGA Coffee Talk. These are our weekly sessions where we'll be providing industry insights to agents. We share product updates, market trends, policy changes, and marketing that will help agents find the sales and grow their business. We post these on YouTube every Tuesday before noon and for our listeners on your podcast platform of preference. My name is Trent Zimmermann, and I will be your host. This week, we're joined by my next door neighbor in the office and resident annuity expert, Ryan Chester. Ryan, thanks for joining us.
Hey, good morning, Trent. Thanks for having me. Appreciate it.
Hey, so you've told me a few times a story about how you wanted to end up in the finance industry. Can you share that story for everyone?
Yeah, of course. So growing up, middle class neighborhood, um, wasn't really surrounded by any people with much wealth, except I had an uncle who, when I was younger, I looked up to him. Man, he was doing it right. He had the house and the cabin in Big Bear, and he had the Porsche, and he had all the nice clothes. He took us out to nice dinners, and I could tell he did something different. He wasn't like the people that I grew up around, and it made an impression on me when I was young. He would show up to football games in his Ferrari and take me for a ride after. I'm muddy and dirty, and he could care less, and I thought that was awesome. So at a young age, I always looked up to that guy. I want nice cars. I want nice things. I want nice places. And as I got older, I started to think about what I want to do for a living. And I had no idea what he did, but I want to do whatever he did. And as it turned out, he was a commodities broker, moved into more the stock world and then bonds. So ever since I can remember, I want to be exactly like Uncle Al, and that's what pushed me into the finance world.
So then how'd that lead into life insurance?
I started in the business working for an independent broker dealer called Centaurus Financial about 19 years ago, I suppose. And I was tending bar at a restaurant right across the street from their office, and I had some clients that would come in, some regulars. And finally, after a couple of years of knowing these guys, like, what do you want to do? I said, well, I'm going to school at Cal State Fullerton. I'm a finance major. I want to get in the investment business. And it turns out that's exactly what they did. So they hired me on at Centaurus, and I was running their marketing department for a couple of years. And I was responsible for recommending different products from various types of annuities to mutual funds, what have you. But at a certain point, I realized my last name's not King, and I'm about topped out to where there wasn't too much more upside for me. And I
Mhm.
took a look around and like, where are the guys making money? And this was probably about 2000, geez, I don't know, maybe like 2008, 2009.
Yeah.
And the big dogs at Centaurus were selling VUL. And I knew a guy who had his own IMO, general agency, BGA, whatever you want to call it. So I figured I'd give him a call. And he was interested in bringing me on. So I left the broker dealer world and took a chance on the insurance business. And and I've been here ever since wholesaling.
Nice. And so how'd you build your expertise in annuities then?
Yeah. So when I was at Centaurus, I was pretty familiar with the different types of annuities. I had relationships with other general agencies that would actually wholesale to the registered rep at Centaurus, but
Mm.
I was day to day in that world. So I had a pretty good understanding of what they were, how they worked, who the players were. And when I came over to BGA, um, after a couple of years, I took over the annuity department. It was just a natural fit. I was somebody within the system who already had this fundamental understanding of what they are and how they work and how to use them. And it was just plain old get your boots dirty and just go to work and figure it out. So, I didn't go to some annuity university or have any special training. It was just on the job, making stuff happen, learn as you go type stuff.
Yeah. And so how'd you end up here at BGA?
Yeah, when I was at the other general agency, things weren't looking great. Um, Production was down. I didn't see that firm lasting much longer, and I was right. So I figured the best course of action would be to reach out to the different wholesalers at the various insurance companies that we did business with, whether it was John Hancock, Symetra, Lincoln, and ask these guys, like, where do I go? Because they know. I mean, they're working with everybody, and if they're not working with them, they know who has a reputation. And interestingly enough, they all said, you got to talk to Barry Zimmerman over at BGA. So I spoke to him and I didn't speak to anybody else. I'm like, I'm in. Let's go. This is home.
Awesome. So get me up to speed. What just happened with annuities this last year? It seemed like no one was talking about them, and now everyone's talking about them.
Yeah, the interest rate environment had everything to do with it. Um, for a long time, we have been in a decreasing interest rate environment, and it's just hammered these annuities. We've seen caps coming down year after year after year, and the insurance companies, gosh, I don't even know how many years it's been. Look, 7, 8, 9 years ago, they realized that the old school S&P 500 with annual point to point with a cap just isn't sexy anymore. Caps are too low, and they were smart, and they created these uncapped strategies that gave the ability to earn yields exceeding whatever the cap was in the market. And now you had a conversation about being able to have double-digit rates of return when the markets do well, and they become sexy again. You had something to talk about, and that's all fine and dandy. But um, when rates are low, there still wasn't a whole tremendous amount of upside available. But when we saw these interest rates start to bump up, things got really hot. Caps skyrocketed. Guaranteed rates on MIGAs went through the roof. I mean, today we're looking at guaranteed yields 3, 5, 7 years, somewhere in that 5 to 6% range, which is great.
Yeah.
It's attractive, and people are gravitating toward that. The other thing is COVID got people concerned about their health, their money, what's going to happen in the future. So it made a lot of sense once people were able to either A, get back into folks' homes, or B, get comfortable with Zoom and presenting over the internet where you're not necessarily face to face. Once you can get back in front of these clients, I think people were more apt to protecting themselves, protecting their money.
Hmm.
Protection was important to them again, because protection in a bull market is not something that's front and center. Everything's great. We're making money in the stock market. What do we need to put the seatbelt on for? Let's
Right.
just keep rolling. So it's hard to have a meaningful conversation when things are great about protecting your assets. But when people were faced with some real extreme volatility in the market and some extreme circumstances from a health perspective, coupled with rising interest rates, that was a perfect storm for annuities, and we saw a tremendous amount of production.
Yeah. So, and we talked to Sean about this, about how much just life insurance products in general have developed over the last couple decades. And I know there's some group of advisors out there who say, don't do annuities. But the annuities today look a lot different than they looked even 10 years ago. So how different are these products from just the last time the rates were even this high?
Yeah, they're different. I think the difference is you have these uncapped strategies, which,
Mm.
listen, at the end of the day, we're still dealing with a fixed insurance product. Okay. So I'm going to answer your question in a couple different parts. One, what makes them different? Uncapped strategies. Now, just because you have the ability to earn double-digit rates of return doesn't mean that that's something that you should count on, because we're still dealing with a fixed insurance product. So you may look at an illustration that's showing double-digit rates of return, and as the average, come on, we're dealing with something that has the same risk profile as a CD. Do you honestly expect to earn double-digit rates of return every single year with a product with no market risk, no fees, no nothing? No,
Mhm.
it's unrealistic. But having the ability to do that is really, really cool. Like, you don't have the ability to do that in a cash position. You don't have the ability to do that in a CD at the bank. You just don't. So even though we can't bank on that return as an average each year, having the ability to earn those rates of return when the markets do start cranking, like, that's really, really cool and exciting. And that's different. That wasn't available, back when rates were up 15 years ago, or whatever it was. It just didn't exist. So although I think some of this stuff's a little bit aggressive on paper, the ability to do it's awesome. And you just can't get that in any other safe money position. So allocating a portion of somebody's portfolio to something like this makes a lot of sense. There's also some stuff out there that we can use in terms of riders, whether it's a guaranteed lifetime income rider. Those existed, but now there's income riders that allow for increasing income. And that wasn't around back then. That's not new today, but it's new since then. So this gives you the ability to maybe keep pace or have some sort of hedge against inflation, right? We have some income that's going to continue to increase each year, that we have some positive market performance. That's cool. The other thing is there's these long-term care annuities, and these were not around back then. So when you look at the long-term care landscape, we're in a really, really opportunistic time, because you have states who are looking at implementing mandated long-term care plans. Washington did it last year. They were the first. Now there's a bunch of other states that are looking to do it. California is one of them. We have a big presence in California. And so what this says is anybody who's working in the state is going to have two options. One, you can go buy your own long-term care plan, and that's fine and dandy. Or if you don't have a long-term care plan, or it doesn't meet whatever stipulations they set, you're going to be forced into the state plan. And just like most state plans, they're not great, right? I mean, is it better than nothing? Maybe. But they're sort of this one size fits all for everyone to satisfy some criteria that might not be great for you. And when you look at the available long-term care products, you have traditional long-term care, you have life insurance with long-term care rider, you have some asset-based long-term care products on a life chassis, but there are also long-term care based annuities that a lot of people don't know about. And what makes those really interesting is when you're dealing with a life-based contract with long-term care, you're getting underwritten based on mortality and morbidity. Versus when you're buying it with an annuity, there's no mortality aspect to it. There is no tax-free life insurance death benefit component. It's just an annuity. So it's purely a mortality play. So it makes these products a heck of a lot easier to qualify for. I mean, heck, you could have somebody who has had cancer 6 months ago, but now they're cancer-free and qualify for an annuity-based long-term care contract. That's incredible. They're a flat decline on the life-based chassis. Okay.
Right.
So these are just some really cool products that are around today that just flat out didn't exist back when rates were high.
Yeah, that's a really interesting way of designing a workaround from this tax that isn't the traditional long-term care that you're having that ballooning premium.
Yeah, and what's really cool about that is, let's pretend for a second somebody has an old non-qualified annuity. That's just another asset in their portfolio. They don't need it for retirement income. Yeah, maybe they'll dip into it at some point, but it's not what it's there for. It's just another asset in their portfolio that's hopefully growing. You can do a 1035 on that policy into one of these long-term care-based annuities. Now let's pretend for a second. Let's say they bought this 10 years ago for $100,000. Now it's worth $200,000. Well, that's $100,000 of basis. You have $100,000 of gains. With annuities, gains come out first, taxed at ordinary income rates. Well, check this out. You do a 1035 on that contract, the full value is $200,000, irrespective of what's gain and basis. Okay. So you take that $200,000, you move it into a long-term care-based annuity. You take that $200,000, and now it turns into $600,000 of tax-free long-term care money that, if accessed for long-term care purposes, comes out completely tax-free. So this one, you're getting a double whammy. You're getting a 3 times leverage, but even those gains that you've never paid tax on come out tax-free for long-term care. That's really, really cool. There's a lot of people out there with non-qualified annuities that they don't need for retirement. Oh, and by the way, if something happens and you need to access that money, it's liquid. If it's not all there in the first couple of years, it's going to be after that. Or maybe let's say it's 96 or 98% liquid in year 2. It's almost all there. So the money's there if you need it. And if you don't, you have a long-term care event, you got a boatload of tax-free dollars that you can access. Really cool stuff.
And so best case scenario, I put my money into a long-term care annuity.
Mhm.
and I don't have a long-term care event, what's the outcome there?
Yeah, and that's great. You know, with the traditional policy, if you don't use it, you lose it. Right? You pay these premium, it's gone. Just like auto insurance. Hopefully you don't need it, but guess what? There's no rainbow at the end of that thing. There's no pot of gold at the end of the rainbow. With a long-term care-based annuity, because it's annuity, there's a cash value component to it. So that beneficiary is guaranteed to receive at least whatever you put into the policy.
Hmm.
It's all there. So there's no risk in losing that asset due to not using it. And the other piece is beneficiaries are not penalized by surrender charges. So if God forbid the owner passes away during that surrender charge period, no harm, no foul. They get all their money.
That's great.
Yeah.
Now, you talked about the writers there. Another thing I've heard a lot about this last year were the bonuses.
Hmm.
What were they? How did they work?
Yeah. Yeah. We've seen a giant uptick in bonuses, but you know, bonuses is a tricky component in the annuity world, and there's a lot of confusion about it. There's a
Mhm.
lot of confusion from the agents to the clients, and quite frankly, it's a mess. You get insurance companies who they want it's all about marketing, right?
Right.
Um, and unfortunately, it can be deceptive and clients don't understand the difference between the bonuses. There's two types of bonuses in the annuity world. There's a true premium bonus, which is actual cash, money you can walk away with. We surrender the contract, we can walk away with that money. We can put it in our hand, in our bank account, we can spend it. All right. Now, the other type of bonus is an income-based bonus. Now, this is a big bonus that insurance companies love to promote. And unfortunately, some advisors don't communicate properly to the client that this is not real cash. Okay. This might be a 20, 25, 30% bonus. It sounds amazing, right? Anybody would want a 30% bonus. But unfortunately, some clients think that's cash and it's just simply not. It's a bonus that's applied to the income base. The income base is simply a phantom number that helps determine the amount of lifetime income you can generate from a contract. So
Mhm.
bonuses are amazing, both kinds, premium and income based, but it's very, very important to understand what type of bonus we're talking about based on whatever the product is. Like I mentioned, you might see income based bonuses 20, 25, 30%. On the cash side, they're not going to be anywhere near that. They might range anywhere from, I don't know, 5 to 18%. Now, we did see bonuses really, really skyrocket last year. Athene's a carrier that's got a phenomenal bonus. That thing ranges anywhere from 9 to 18% depending on state, and that's a real cash bonus. And what I like about their product in that bonus is you might have clients who have had some losses in their investment portfolio. And what do you do? How do you make up for it? Do you ride the market out and wait 5 years for it to come back, or however long it takes to get back to even? Or do you say, look, let's cut our losses in this investment. Let's move that money into one of these Athene contracts with a real cash premium bonus. And now we're starting out 18%, 16% ahead of
Yeah.
wherever we're leaving off in that thing. And maybe that's enough to overcome some of these losses. So you picked them up, guaranteed. We have a new starting point, and now let's see what we can earn moving forward. So the bonus contracts are really, really lucrative right now, and I think people need to take advantage of them where they can, whether it's simply to create more lifetime income or just to get that big bump day one moving into these things. So very attractive. Yeah, a lot of activity in that world.
Right. Now, I'm hearing rumblings of interest rates possibly dropping. You're talking about where we're at right now. Are you still confident and bullish on annuities this year, or is this
I
something
am.
that people need to get in on right now?
No, I think this year is going to be good, at least for the first part of the year. I was watching the news this morning as I was getting ready for work, and I saw the Fed decided to not make any cuts. They're going to hold steady on the rate. Um, Now, who knows how long that's going to happen? They're talking about 3 rate cuts as this year progresses. How big they'll be, who knows? But as the Fed cuts the rate, you're going to see annuity rates drop. So I think this year will still be good. But I also think that you need to get in on the action and take advantage of what's out there right now before it drops, because they're not going to improve this year. It's just not going to happen. They're going to scale back. The question is how much. And we don't know. Like, just like I don't know what the stock market's going to do. My crystal ball broke a long time ago. But if I can take advantage of the bonuses and the guaranteed yields and the caps that we have today, you better take advantage of them because they're not going to get better. I'm not saying that they're going to get much worse, but they're going to slide a little bit. How much is the question? So sometimes you get advisors and clients asking, maybe I'm gonna wait 2 months, 3 months and see what happens. Why wait and see? We
Yeah.
know the rates are not going to improve. The only thing that's going to happen is that they're going to go down. Again, how much? I have no idea. But I do think this is going to be a phenomenal year for annuities again. Um, Interest rates are still high. We're still experiencing volatility in the market. So there's a great conversation to be had about protecting a portion of somebody's portfolio that they can't afford to lose. And that's irrespective of where rates at. That has nothing to do with bonuses. That has nothing to do with any of that. That's just a simple fundamental piece of financial advisory. Look, everybody has some piece of their portfolio that they can't afford to lose or they don't want to lose. Everybody. Now, that percentage or that dollar amount is going to vary based on their specific profile, but everybody has some piece. And when you look at what are our safe money alternatives and options for that piece, an annuity makes a heck of a lot of sense, at least for a portion. I'm not saying put all of it in an annuity, but some of it, heck yeah, at least let's have a conversation about it. So, I always think that there's a good market for annuities, regardless of what rates look like. But right now is a really, really good time to lock up some yield and big bonuses for sure.
So, you talk to agents a lot in your day-to-day business. So, when you're talking to them and coaching them through what's out there, what are you talking to them about in terms of the people who might be best suited for these types of products?
Yeah. So there's a couple things there. One is, the guy who just sells life insurance or annuities, they're very few and far between. A lot of folks do other things and they cross sell their existing client base on life insurance and annuities. Okay, so maybe they're a property and casualty broker, maybe they're a money manager, or maybe they're a CPA, or they're, I don't know, whatever. They have an existing client base, Medicare, that they can tap into to sell annuities. Because the reality is, like I mentioned, everybody has some piece of their portfolio that they can't afford to lose. Now, that doesn't mean go talk to the 35-year-old about this. That's not the market. But 60 and up, 55 and up, maybe a 50-year-old, somebody that's near or in retirement, there should be a meaningful conversation about annuities. So I talk to people, look, identify your book of business. A lot of you already have these clients. You already have the relationship. You're just selling them other stuff, right? So go in and talk to them about protecting some of that money that they can't afford to lose. So a lot of them have clients that are already perfect and ripe for annuities. But then, who do you know that works with those types of clients? Do you have relationship with CPAs? Do you have relationships with estate planning attorneys? These are two professionals that hold the keys to the castle. They know where all the money's at, right? And they're a fiduciary. So when they make a recommendation to somebody, a CPA, for instance, when they make a recommendation to you, Trent, say, hey, look, you need to do this or you need to do that, you don't question it. I mean, maybe they don't just, it's not a free for all, right?
Right.
But you generally take that advice as good advice that you're willing to have a conversation with somebody about. And there's a high likelihood that you're going to do it because it's in your best interest. So when you have these strategic relationships with these types of advisors, and you can build some sort of trusted advisor relationship with them and their clients, and they say, hey, Trent, you should talk to Ryan about protecting, this IRA that you have over here that's subject to market risk. You're 60 or 65, you might not be able to take the risk that you currently are, and it might be worth protecting it, or at least having a conversation about protecting it. That's a really strong referral. So I encourage these advisors to look within their own book. Who are you working with? Especially that 60, 55 and up stuff. And then what strategic partners do you have out there that would be willing to introduce you to some of their clients to protect some of their assets? Those are two really good areas to be focused on.
So when you're talking about having those conversations, where are you seeing the most success with agents you work with? Are they doing this in annual reviews? Are they calling up people who just fit the demographic? Or are they really pushing those strategic relationships? Or is it a combo of all those?
It's a combo of all of it, but right now is the perfect time for Policy review, new
Yeah.
year, let's take a look at what you got. And the reality is, like, and people who sell annuities are notorious for selling annuity and then they're gone. Nobody's looking at this stuff. And just like anything, these products are getting better. So cell phones, you could still have a brick phone from the 90s that can still make a call today, but it's not this supercomputer that we have sitting in our pockets 24/7, right? Annuities are always getting better also. So, there's a lot of opportunity at looking at these old annuities that we have on the books or that exist out there and upgrading them with this new, more modern type annuities that are available in today's market. So, yeah, policy review is a phenomenal way to drive production and really help these clients out because there are a lot of underperforming old or just bad contracts out there that we can upgrade. As long as they're 2 years old or older, those things are ripe. Those are ripe. We can replace them and get them into some better stuff. And then yeah, it's constantly looking at the book, doing marketing, getting referrals throughout the year. But policy review right now is a really great idea.
Yeah. Okay, so 2 years and older, start having those policy reviews and start
For
switching them out.
sure. Yeah.
All right, so I've got two more sets of questions for you, and these are outside of annuities. The first one's our Kohler question. We've asked this to everyone. Kohler, as you know, makes some great bathroom instruments like toilet. And so this is about cases that are just ready to be flushed down the drain.
Okay.
But you had to go in and save it. For whatever reason, bottom line, something personal in your life, or just for the sake of your own ego, you wanted to get it back on track. Can you share your favorite story of a situation like that?
I've got a lot. And I don't know which one's my favorite, but I got a recent one. So that one's top of mind. We had a big case out in New York. It was maybe like 1.4 million. We closed it a month ago, maybe. And it was a nightmare from the get-go. And if you know anything about doing business in New York, it's tough, especially when you're dealing with the replacements, because you got to go through something called Reg 60. So this like extra layer of crazy compliance and scrutiny when replacing life or annuity contracts in New York. And when we started this case, the licensing took forever. The Reg 60 process took forever, and we'd have to go back to the client and get some corrections and just updated figures that required an additional signature or a set of initials on it. And it was just one thing after another. And the client was super over it. They were ready to pull the plug. The agent was over it. They were ready to pull the plug. But at the end of the day, like it made a lot of sense for the client just to hang on because we were getting them so much more income from this asset than they were getting previously. So everybody wanted to throw in the towel, including myself. I mean, I was over it too. But unfortunately, it was just what happens sometimes in replacements business in New York. And I tried to tell it to the agent, like, I totally get it. This is a nightmare and I'm sorry for it. But we just got to go back one more time and get this extra set of initials. The client's going to be so much better off after he gets done with this thing and the end is near. Like, just go back to him again. And that's the last thing I ever want to do is tell the agent, go back to the client again and again. Like, that's the absolute worst case scenario. But the client didn't give up, the agent didn't give up, we didn't give up, and we got this deal done. And the client's getting like 20% more income off this asset. I mean, it was significant. So it was in his best interest for sure.
Yeah.
We don't get salaries at BGA. So at the end of the day, we're just like the agents. We don't get salaries either. So if this thing doesn't get done, all that work was for nothing. There's no money to be had. So we got paid, they got paid, the client's getting paid way more, and it was worth it. But man, it was a bear. That thing was in the toilet ready to be flushed for sure a couple times.
Then I like that last statement you said about, we don't make salaries here. And because I hear you through the wall a few times a day saying, I got to be able to sleep with myself at night. And yeah, there's a lot of regulation in our industry that says you got to do this in the best interest of the client. There's the moral compass side of I need to do what's best for the client. But we're not sitting here like you're talking about just saying, I hope that case comes in. You're working hard to make sure it goes through.
Yeah, and that's
on the best interest of everyone.
Yeah, and I get asked by new agents all the time that don't know who we are or what we do, and I'm trying to recruit them to do business with us. And they're like, what makes you different? What programs do you have? And the truth is, like, yeah, maybe we have something that's a little different from somewhere, and maybe this other BGA has some little program, but it's generally not anything significant. The truth is, we all do the same thing. We all have the same carriers. We all have the same products. We all have good relationships. That's all fine and dandy. Telling you we're the best at all that stuff is a bunch of BS, and that's what everybody's trying to do. The
Yeah.
thing that makes us different is the way that we're paid. And not getting a salary creates a completely different culture at BGA. When you call me and say, hey, Ryan, I got a guy, he's 60, he's got $250,000. We're looking for whatever we're looking for. Like, I'm not going to get that to you tomorrow unless I'm so buried I just can't get to today. I'm going to try and get you that in like an hour. Okay. Even if
Yeah.
you're meeting with the guy next week, I want to make sure if you get in front of that guy early, you are ready to make that sale. When a case comes in and gets submitted, our case managers aren't just going to sit on this thing and get to it when they get to it. They're going to try and hammer this thing through as fast as they possibly can because guess what? They have kids to feed. I'm going to be on them to make sure it gets done quickly because I have kids to feed. And
Yeah.
nobody's eating unless that deal gets done. So who's that good for? It's good for the client. They got it done quickly, and it's good for the agent, right? They got paid as well. So we're like a true extension of the agent's team. And it's not like I'm working down the street for an agency getting paid 100 grand and I might get a couple shekels if you close the case. So I really don't care if it closes or not or when it closes. No, I don't have that luxury. So everything's going to get worked on with priority here. And the advisors that do business at BJ, they know what it is. They understand what that feels like and how that's different. And that's really one real significant thing that sets us apart from other agencies in the country. Because as far as I know, I haven't heard of any other agency structured that way. They all get a salary. We don't.
All right. Well, now for the speed round for you. So, answer just initial gut reaction.
Okay.
Favorite type of barbecue?
Wait, say that one again.
Favorite type of barbecue?
Oh man. Um, I like a vinegar-based pulled pork sandwich, whatever you want to call that.
All right, that answers my next two. I was gonna say pork or beef.
Oh, pork. I come up from the competition barbecue world and actually part owner in a barbecue restaurant. And my favorite meat to cook is brisket because it's so hard.
Yeah.
I don't like it. It's terrible. Like I just don't enjoy the flavor of it. I'll take pork all day long if I'm eating it, but if I'm
Yeah.
gonna cook it, I want beef because it's really, really hard to do.
Yeah. All right. So vinegar or ketchup base? I think you answered that one too.
Yeah, yeah. Give me some vinegar. I want some twang on that thing.
Baseball or football?
Oh man. Um, Baseball for sure. If you know me, I'm head over heels and into baseball because I coach my son's team. Um, and I just love being out on the ball field with him. I always loved playing it growing up. But the thing is, I don't watch it. I can't watch a baseball game if my life depended on it, if it's professional level. I'll watch these 8-year-olds play all day long and I love it. But if we're
Yeah.
talking about professionally and I'm going to watch something, it's football. So that's football and baseball in the same answer.
All right. Jiu-jitsu or Muay Thai?
Muay Thai is my first love. Jiu-jitsu is great and I enjoy doing it, but Muay Thai all day long. It's not even a question.
All right. Best active fighter right now?
Oh gosh, I'm going Sugar Sean O'Malley. The kid's incredible. He comes out, he styles on guys. He's putting people to sleep. Everyone bets against him. He still knocks them out. I'm on that Sugar Show train all day long, and I love watching him.
All right. Beach or lake?
I'm gonna say, oh man. Um, I'm gonna go with the lake because if I go to the beach, it's gonna be for a couple hours. If I'm gonna go to the lake, it's a couple days, and I get to spend more time with the family and have a good time with the kids. So at this point in my life, I'm going lake.
So, surfing or wakeboarding?
Well, it's sort of a mix between the two. I have no chill. So if I
Yeah.
wakeboard, I'm going 8 feet in the air, flipping, but that results in separated ribs and concussions, and I'm too old for that. I'm past 40 now, and
Yeah.
I don't need to be doing that. So I really enjoy wake surfing. I'm going 10 miles an hour. I can't get hurt. It's a blast, and I can do it at the lake while we're hanging out with the family. Wake surfing's my thing right now. It's a great time.
I get it. Wakeboarding hurts too much now.
Yeah.
Awesome. Well, thanks for joining us and thanks for doing this with me.
Thanks, Trent. We'll do it again. Appreciate it.
Oh, for everyone here, follow, like, subscribe. We're putting these out every week. Participate along. Our goal is to get these out and get enough of a following that we can do these live. So follow, like, and subscribe, comment, tell us what you want to see more of, and we'll get more out to you. See you next week.